Well, hi everyone. Welcome to Tax Bracket Myths Busted, what you really pay and why it's less than you think. I'm Julie Kern. I'm a CPA, certified financial planner, and certified divorce financial analyst, better known as a financial advisor, tax strategist, and a dream coach. So today's webinar is going to take us through some of the ins and outs of tax brackets. Well, while I'm talking about that, I will bring up our disclosures so that you can read those at your leisure. This will also be posted to our website, this webinar. So if you want to read the disclosures in more depth later, feel free to do that. But today we'll be talking about some of the issues and specifically some of the myths around our tax system and just explaining a little bit about how tax brackets work. So here's our agenda. First, we'll be talking about what is a tax bracket. Next, we'll look at the differences between the marginal and effective tax rates. Third, we'll talk about both the capital gains tax and the AMT. Fourth, we'll spend a little time talking about what is going to happen in taxes after this year. Fifth, we will go over those tax myths and bust those, and then we'll have a little time for questions at the end. Since this is such a dry topic, I wanted to set the mood. So let's start off with a little joke. Why do CPAs like holidays? There's less traffic on the way to work. It's my favorite joke. And one more joke. Where do homeless CPAs live? Anyone know? In a tax shelter. And then we have this little cartoon on the right. This guy in this big pile of paper. Congress simplified the tax code again. So isn't that the truth? So let's start with what is a tax bracket. So basically, the way the US income tax system is organized is that a tax bracket is a range of incomes that are taxed at a given rate. So you can see in this chart the current tax brackets. There are 7 of them, and they range from 10% all the way up to 37%. And you can see that some of them, the distance between tax brackets is not very much, like between 10 and 12, between 22 and 24, and between 35 and 37, it doesn't jump up very much. But there are a couple of points in our tax system where the rates really jump up. So if you were in the 12% bracket and you made a little more income, that might bump you all the way up to the 22%. And similarly, if you're in the 24% bracket and you make some more income that year, you could end up in the 32% tax bracket. So all of this points to why tax planning is really helpful, because if you were just on the cusp of making one of these leaps, some tax planning could quite possibly keep you back in that lower tax bracket. So this type of tax system where higher incomes are taxed at higher rates and lower incomes are taxed at lower rates is known as a progressive tax system. So these are our current tax brackets. So I've listed them here by single filers, married filing joint, head of household, and then married filing separately. So at the 10% level, if you're a single person, as long as you make under roughly $12,000, you'll pay taxes at 10%. Similarly, for married folks, you can make almost 24,000. For a head of household, which is usually a single person with children, going to be 17,000. And then the married filing separately, it's really interesting. Well, to me, it's interesting. The brackets are exactly the same as single for the 10%, the 12%, the 22%, the 24 and the 32, but look what happens when you get up to the 35 and the 37. That top income rate for singles can go all the way up to 626,350 and still be at 35%. But for married filing separately, it's only 375. And then similarly, anything over that goes to 37%. So that's one of the ways that they gouge people who file married filing separately. So good things to pay attention to. Okay, let's talk about marginal versus effective tax rates. So your marginal tax rate is the rate of tax paid on the next dollar of taxable income. So we know this as your tax bracket. If someone says that they're in the 24% tax bracket, what that means is if they earn one more dollar of income, it would be taxed at 24%. The effective tax rate is basically like the actual percent of tax that you pay on your taxable income. And the formula for that is just taking your tax and dividing by your taxable income. And that's how you get that calculation. So because these are different, and it's because of the different tax brackets, it creates some confusion with people sometimes. So let's do an example. If anybody out there is a Friends fan, that's my theme for my examples today. So this is Monica. Monica's a chef in Friends, and she is a single taxpayer with taxable income of 145,000. Her tax liability on that would be 27,647, and her marginal tax rate is 32%. So what is Monica's effective tax rate? And the answer is dividing the tax by the taxable income, which is 19%. So you can see that this is quite typical. Someone's marginal tax rate is going to be significantly higher than their effective tax rate. So if someone says, I pay 32% taxes, what they're really meaning is some of their income is taxed at 32%. But if you were to take the effective tax rate, it would probably be a lot lower. Okay, so now let's look at the capital gains tax rates. So most people have some understanding that capital gains are taxed at a lower rate than what we call ordinary income. And the tax rates for capital gains are going to be either 0, 15, or 20%. So for single people, you can make to 48,350 in a year. If it was all capital gains, you would have no taxes for that year. For married filing joint, it goes all the way up to 96,700, and then some modified amounts for head of household. And again, married filing separate follows single at the 0% rate, but then at 15, the top end is much lower than a single person could get. Okay, so there are a couple of tax planning strategies that can be employed if you have capital gain income. So one is to shift capital gains to children. So by setting up an account and gifting shares of stock that has appreciated to a child, and they sell the stock and realize the capital gain on that, they could have as much as, going back to the previous slide, $48,350 in capital gains without having to pay any taxes on that. The second strategy is triggering capital gains up to the top of that 0% limit for taxpayers without high income. So in our business, we have some clients have very high pensions or other types of income. But for clients that have high assets but not high taxable income, we can typically we have two strategies that we consider each year, and we take the one that works out the best. But it's either going to be triggering some capital gains at the 0% tax rate, or instead doing a Roth conversion. And so when we map that out over several years, we can kind of see which would be the better option for each client. So then the next question is, how do capital gains tax rates work with the regular tax rate? So if you have some of your income is ordinary and some of your income is capital gains, and they have different tax brackets, what gets taxed at what rate? So these are the general rules. Ordinary income is taxed first. So as we're thinking about the tax brackets, starting at 10%, we would fill that up with your ordinary income. Perhaps it goes into the 12% bracket as well. Then we would add the capital gain on top of that. And then it's also important to know that any of your deductions, so whether you itemize deductions or you take the standard deduction, those are deducted against your ordinary income first. So I have an example here for us. Ross and Rachel are married and have $60,000 of, oops, you know what? I changed this. I'm going to edit it really quick. Well, here, I'll just jump to this. They have $80,000 of ordinary income. Their standard deduction is $30,000, so that leaves $50,000 of taxable ordinary income. Now, this $50,000 for a married filing jointly couple would fill up all of the 10% bracket and a portion of the 12%. And then, so therefore, the tax on that would be a combined rate. The dollar amount is $5,523. Then the 60,000 in capital gains would get added on top of that. And so this diagram over here shows how it gets filled in. So the taxable ordinary income is first. So it goes up here to the top of the 50. And then the capital gains income starts there. So the tax on the capital gains, in this case, for married, let me go back to my chart here for the brackets. So you can see for married filing joint, the 0% bracket only goes up to 96,700. So only the portion from 60 to that 96,000, about this much of it, would be taxed at 0, and then the rest would get the 15% treatment. So in that would total 1995. And so then if we add the 5,500 number and the 1900 number, their total tax would be 7,518. So the point here is that the more ordinary income you have, it fills up that 0% bracket for the capital gains. So that if you then have capital gains on top of your ordinary income, you're losing out on part of that 0% bracket, or potentially all of it. If their ordinary income had gone all the way up to that 96,000, then they would not have gotten any of their capital gains taxed at 0. Okay, so now let's talk about the AMT. The AMT is the alternative minimum tax. And this is something that used to be a problem for a large number of our clients in past years. But after 2017, when the Tax Cuts and Jobs Act was passed, there were some changes made that have really reduced the number of people who are subject to the AMT. It's down to 0.1% of taxpayers. So we won't spend a lot of time on this since it most likely doesn't impact you. But what the AMT is it's a separate and parallel tax system, and it requires some taxpayers, well, to calculate your tax liability twice. So first under the regular tax system, secondly under the AMT, and then you pay whichever is the highest. And the reason that this was started is because of it was back in, I believe, 1950 or 60 something. And they found that there were 155 wealthy taxpayers out of the entire nation who paid zero taxes. And so this was basically to close a loophole, as are many of our tax laws. And it just at this point is not, there just aren't very many people that fall into that. So it really doesn't affect very many people anymore. So these are just some of the things that trigger the AMT. The most common one that we see is if someone gets incentive stock options through their employer, those can trigger AMT, but it can also come into play if someone has like really high ratio of capital gains to their ordinary income. It can come from tax exempt income from private activity bonds, and then some one-off things like intangible drilling costs, depletion, and accelerated depreciation, but only on certain types of property. So you can see just from this list, these are not probably things that you see on your tax return, but they can come up. So just something to be aware of. Okay, now talking about the Tax Cuts and Jobs Act, it is scheduled to sunset at the end of this year. And so what we're seeing is, of course, bills being created. There's a bipartisan bill trying to get passed. So my prediction is that most of what's in the current tax law will stay, but these are some of the things that would change if these tax laws are allowed to what they call sunset. So it means they were enacted only from 2017 to 2025, and then they just everything just reverts back to the way it was before then, with some inflation adjustments if no further action is taken by Congress. So it would result, if these laws are allowed to sunset and we go back to the way things were, we would have higher tax brackets, we would have smaller standard deductions, but personal exemptions would be a thing again. The qualified business income deduction would expire, and that one would actually impact quite a few of our clients, even if you just have a small, kind of home business. You, if you have a profit, you're probably getting a 20% deduction on that for this QBI. Mortgage interest deduction limits would increase. So currently, mortgage interest can only be deducted up to a loan of 750,000. It would then go up to $1 million if this sunsets. Charitable contributions would go back to being limited to by 60% of your adjusted gross income instead of 50%. Currently, there is a $10,000 per year limit on your total state and local tax deductions. So it's going to be your state income tax or sales tax, your real estate taxes, and your vehicle licensing taxes. Currently, if those total more than 10,000, it gets capped at 10,000. So that cap would go away. And the gift and estate tax exemptions would revert back to around $5 million, and the child tax credit would be reduced. Okay, so let's move on to some common tax myths and bust them. Okay, myth number one, all of your income is taxed at one rate. And the reality is that because of our graduated or progressive tax system, you pay different rates on different portions of your income. Second, I will be taxed on my inheritance. So there is no federal inheritance tax. There is, however, a federal estate tax, but that is paid by the decedent's estate. And that would be prior to your inheritance being distributed. So even in cases when there is an estate tax, the estate tax exemption under current law, now this is the Tax Cuts and Jobs Act, is 13.6 million. Now that could revert back to around 5 million, but still for a lot of people, that would not result in an estate tax. Myth number 3 is that you'll be in a lower tax bracket in retirement. And this is not totally a myth because it can often be the case, but it is a myth to just assume that it will be that way. So if you have income from multiple sources, such as retirement plan distributions, pensions, and Social Security, you could actually find yourself in a higher tax bracket. So tax planning is key to making sure that you know what your tax rates are going to be, and then also do planning to mitigate whenever the rate might be higher than you are currently paying. Okay, this is a really important one. The IRS will call you if there's a problem is a total myth. The IRS never initiates contact by phone, text, or email. And even if you get a phone call and they tell you that your Social Security is going to be cut off, that's a really common one. Don't believe them. It's a scam. Do not talk to them. Do not provide any information, especially personal information like your Social Security number, your date of birth, anything. Just hang up. The IRS will always send you a letter in the mail, and they will expect you then to call them or respond by mail. Okay, this is my favorite one. Your tax preparer is liable for mistakes on your return. A lot of people have a misguided assumption that if you hire someone to prepare your tax return, like a CPA, that takes you off the hook for any information that might be incorrect on the return. And in fact, that's not true. So when you sign the tax return, which nowadays you're just signing the e-file signature pages, you're putting your signature to attest to the accuracy of your tax return. So it's important to make sure that you review the tax return. And if you have any questions at all, that you talk to the person who prepared it and just make sure that the information that they put in there is completely accurate. Even, we have really great processes at our firm. We have double review of tax returns. It doesn't mean that a mistake could never happen. And then also know that if you provide bad information or incorrect information, the tax preparer has a reasonable due diligence obligation to ask you about it, but is not going to be auditing your numbers or anything like that. So if you have questions about what's deductible, you should ask, and then always just make sure that you review your returns before they get filed. Okay, so to wrap up today's presentation, US taxes are progressive, meaning that the rates are higher the more money you make. The marginal rate is not the same as the effective rate and is often higher than the effective rate. Capital gains tax rates are generally lower, although not always, because you could be a taxpayer in the 10% bracket. And if you ended up with 15% capital gains, that would be higher. And tax laws may change a lot next year or not much. We'll have to wait and see. And honestly, It could be at the very end of the year or even into next year, and then they will make those changes retroactive to the beginning of the year. So I don't expect it to be, I don't expect us to get a lot of that resolved in the next few months, but there should be a flurry of activity closer to the end of the year to get that either passed or not. All right, don't fall for tax myths. The AMT is complicated and taxes are complicated. So obviously I'm a proponent for having a CPA work with you, not only to file your returns, but really where the value is added is in the tax planning. And that's where you can really save a lot of money. Okay, so I'd like to open it up now and see if we have any questions. Okay, let's see. I'll wait a little bit longer. Okay, so first question, what are some ways to reduce taxes I may owe? Okay, so first off, you should talk to your CPA about your specific situation. And almost always there are ways to reduce your taxes. Now, a lot of those may require using some of your cash in a different way. And so you have to be willing to, for example, put more into your 401k is a great example. Definitely talk to your tax advisor on that. Next question. If I am just a simple W-2 tax filer, do you still recommend tax planning? Yes, I do. Still want to pay less taxes. So again, simple things like funding your HSA or your 401k or looking at your withholding to making sure that you are not over or under withholding. Those are all helpful. How do capital gains work on home sales? Great question, and a question that comes up a lot. So, most people are familiar that there's some sort of an exclusion on part of your gains if you sell your house. And that is true. A lot of people are still under the notion that as long as you roll the proceeds into your next house, that avoids tax. And that is not true. That was the old law that changed, I think, back in like 1986. But the way that the current law works is that a person can exclude $250,000 of gain on the sale of their personal residence if they meet the requirements. A married couple can exclude up to $500,000 of gain. And the requirements are that you have owned and used the house as your primary residence for at least 2 out of the last 5 years, and that you haven't excluded the gain on another home sale in the last 2 years. So there are all kinds of complications that come up with this. And if you do significant improvements on your home during the time that you own it, those can be used to reduce your gain. So again, be sure to talk to your CPA or tax advisor about how to plan and make sure that you don't have a big tax surprise. Okay, next question. If I do not need my refund, what are some ways I can put it to good use? So, first of all, I would say adjust your tax withholding so that you're not getting a refund. The ideal amount to owe or pay is 0 at the end of the year. That means you're not allowing the IRS to keep your money for the whole year, and you don't end up having to pay a lot when you file your tax return. So strive for 0. But if you do have a refund and you don't need it right away, there's a lot of things you can do with that. So perhaps that means that you could increase your 401k contributions because you don't need the cash. You have some extra cash. Perhaps you need to build up your emergency fund. If you have a business, perhaps there's a capital investment that you'd like to make. So that gets, I think, more into financial planning ideas. So talk to your financial planner about that as well. Okay, next question. How does gift tax differ from money I inherit? So gifting is given to you during the person's life, and the inheritance comes when a person passes away. Otherwise, they're fairly similar, and the laws are intertwined for gift and estate taxes. However, gifts have some annual amounts, currently 18,000 that you can gift to someone. You can gift to one individual person each year without having to file a gift tax return. But over your lifetime, the gift tax exemption is tied to the estate tax exemption, and it's that 13 million currently, or possibly going down to 5 million. So if you gift more than 18,000 to one person in a year, you do have to file a gift tax return, but there would not be any tax as long as you haven't used up that lifetime exemption. All right. Another question. Are capital gains treated the same on Bitcoin and digital assets? Yes. And we discourage people from investing in those, at least unless it's just your play money on the side of your portfolio. But they're very speculative, and there's a lot that hasn't been figured out yet in terms of regulation, and they just are very volatile. So I would say, if you want to play on the side with a little bit of money in Bitcoin, go for it. But taxes, it's still going to be capital gains tax. And the rules to get the long-term capital gain is that you have to have held that asset for more than 1 year. So a lot of these Bitcoin plays tend to be, some people are trying to make a short term, they don't want to hold it for a whole year. And so then it turns into a short term capital gain, which is taxed at your ordinary tax rate or your marginal tax rate if it's added to your other income. All right. And I think I've answered all the questions. So if we don't have any others, I will just share with you our next online learning event. It will be on Friday, May 30th at 11 a.m. And the title is Epic Fails, the Worst Market Predictions and What We Can Learn. So this will be a really fun one and should help put some things in perspective, particularly with some of the chaos that's been going on in the market right now. All right. Well, thank you so much for attending, and I look forward to seeing you next month. Have a great weekend. Bye-bye.